So today's Cardinal lesson, we're talking about IRA 401k money. And for most people that come into us, this is the lion's share of their savings. I mean, people come in with 700,000 in IRAs and 20,000 in non-qualified savings, or they have 3 million in IRAs and 150,000 in savings. So it's very important that you understand all the attributes of 401ks, and most people don't. I mean, when people come into us, they understand that they got a tax deduction. They kind of vaguely know that they haven't paid taxes on that money. But when we start showing them how much in taxes they're going to pay on that money over their lifetime, it kind of gets their attention. And so if you'll notice on our board, the fourth worry is 401k and IRA. So we pull that money out separately and deal with it, just to make the distinction that this money is different than your other money. And, when you get to the fifth worry, which is income and investment, most people have just put these all together in a glob, and that's what they're going to live off of in retirement. So what we're asking you to do today is put the IRA 401k money over here. We've got your other money over here, and we're going to go through 17 points of how the IRA money is different. And each one of these matters to you. You're going to have to deal with each of these 17 points at some point, either before retirement, but most of them during retirement. So I want to put it to Tom, and I want Tom to share with you why we're doing this video today.
Yeah, we're doing this video because most of you probably have most of your savings in IRAs and 401ks. That's typically what we see. And they are just fundamentally different than all other types of money, right? There's a lot of rules around them, and you need to have a plan in place of how to handle them. And so that's why we're doing the show today. We're going to bring the show notes. The show notes just have these points sort of listed out too, so it's not as detailed as some of the other ones. But again, you can find this at the link below our video. It's also on our website at cardinalguide.com. We have the board, and then we have, again, these different points we have on the board. And so it's really all just repeated on the board. If you want to have it a little bit cleaner and just be able to print it out, you can find these at the show notes. So I'm going to turn it back to Hans. We're going to go through the list here. We're not going to spend a lot of time on each individual one because that would take all day. But we're going to give you enough information on each one and just show you how it's different than the other types of money.
Okay. So the reason this one stands by itself is you need three different areas, three different plans to deal with your IRA money. You need a distribution plan. How are you going to take this money out of there? You need an estate plan. If there's monies left in there when you die, how's it going to go to your beneficiaries, and what's the tax implications of that? And you need a tax plan. There's really a plan to pay the taxes. So we're going to go over the first three of them. Number one is IRAs passed by beneficiary, not through your will. So your savings account, your brokerage account, is just when you die, if you have this joint account with your spouse, well, then when you die, it'll just take your name off and it'll be a single owned account. But if you're, and maybe you put your daughter on there or your son, if you're older and you've lost your spouse, and so you want to have it as a joint account. But there's ways, and you can use a transfer on death on a joint account, but an IRA has a specific beneficiary listed. If it doesn't have that, it's not an IRA. And that beneficiary, when you die, that money is going to go to that person. And it's kind of as simple as that. This is actually a benefit. It will not pass through your will. So it's probably a good time to be thinking about maybe check your beneficiaries. Second point, IRAs have required minimum distributions. So when you think about your brokerage account or your savings account, nobody tells you when you have to pull money out of there. You can leave it in there the rest of your life. And the interest that gets credited or the capital gains you incur or interest paid, that's taxable even within the account. But with an IRA, you have required minimum distributions or RMDs. At a certain age, you got to take out a certain percentage. Third point, there's complex distribution rules in life and after death. And frankly, the ones after death, there's right ways to do it and wrong ways to do it, and they're often missed. So you've got very complex distribution rules for yourself to pull the money out, and then with the money that's left, it's very complex for your beneficiaries to properly distribute the money. So I want to pass it to Tom.
Yeah, so number 4, distributions can incur tax penalties. And so this specifically happens if you are younger, like if you're under 59 and a half with IRAs, there's a 10% penalty on top of the taxes you have to pull out. Other types of money, taxable accounts, savings accounts, there is nothing like that. So again, that makes it different. There's some rules around 401ks, maybe different ages. So again, I don't want to get into the details there, but you got to be careful because if you take it out at the wrong time, you have penalties on top of the taxes that you have to pay. Number 5, highly taxed upon death or withdrawal. And so that's part of the deal you're making with the IRS. When you put money into an IRA or a 401k, and by the way, we're talking about traditional IRAs and traditional 401ks throughout the show. Roth is sort of a separate deal. But if you put money into those accounts, you get a tax deduction on the way in, and then it's got to be taxed on the way out. The principal, the initial amount you put in, plus the growth has to be taxed on the way out. And if you do that in a way, like maybe in a year that you have other high income, or you take a lot out, driving your income up, it can really drive up your tax brackets and the taxes that you have to pay on that. And death, it becomes even more of a problem, right? I mean, your kids have rules that they have to follow. Again, back to the complex rules there, and then they have to pay taxes on it at that point. Number 6, and this is an important one that I think a lot of people miss, is it's subject to double tax upon death. You say, wait a minute, how does that work? And so again, a couple nuances here is assuming you have an estate tax problem, which again, granted, a lot of people don't. But if you do, or if you live in a state where the exclusions are much lower than the federal ones, this could impact you too. Is not only could your beneficiaries have to pay estate taxes on the value of the account, they also have to pay income taxes on that money. And so, an example, let's say you had an estate that was over the threshold by $1 million, and you had $1 million in your IRA. Well, you had to pull it out to pay the tax. You not only would have to pull the money out to pay the tax, you'd have to pay income tax on the way out, get there. So I don't think I made that super clear, but again, it can be subject to double taxation, estate taxes or income taxes. Call us if you're worried about that.
Okay, number 7, there's no step up in basis within a side of an IRA, or there is no basis. Now, what I mean by step up in basis, like if you own some stock that you bought at $1,000 and you held it your whole life and you never sold it, and then when you died, it was worth $10,000, and then your children inherited it, their basis after your death is going to be $10,000 is what it was worth. If you sold it during a lifetime, your basis was $1,000, what you paid for it. So if you sold it for $10,000, you were still alive, you'd owe taxes on $9,000. But the step up in basis for money outside of an IRA is all of those things get stepped up to their value on the date you died. It's a real benefit to hold assets that are outside of an IRA, but there's no such thing as inside of an IRA. Your beneficiaries are going to have to pay taxes on all of the money they receive. And the only question is how will they distribute it to themselves within the law and spread those taxes out. The 8th one, investment gains are taxed as ordinary income, no capital gains. So when the tax bill finally comes due, there's not going to be any capital gains on the growth. Any money coming out of that IRA, a traditional IRA, is going to be taxed at the full ordinary rates. Number 9, investment gains are not subject to the 3.8% investment tax. So we've done other shows on that. There's the net investment income tax, 3.8%. It doesn't apply to IRA money. So I'm going to pass it to Tom.
Yep. So number 10, cannot be gifted or transferred during life except for a QCD or divorce. And so essentially, other money you can gift, savings accounts, taxable accounts, you could gift to a spouse, you could gift to a child. IRAs cannot do that. You cannot gift an IRA except for taking it out, paying the taxes, and therefore it's no longer an IRA. So the IRA itself cannot be gifted. Again, in divorce, it can be split. QCDs, you can gift it away that way. Again, we have other shows on that. But fundamentally, you can't do that. Number 11 cannot be transferred to a trust. So this is related to the other one. Is a lot of estate attorneys, estate tax planning attorneys, what they will do is they'll set up a revocable living trust. They put all your money into this trust. We'll have it passed to the beneficiaries of the trust, and we bypass probate. It makes it all sound great. There's reasons to do that with some of the money. I've seen mistakes happen all the time where attorneys tell the clients, "Oh, just put the IRA in the trust." That should be a red flag from starting at that point. It tells you that they don't know what they're talking about when it comes to IRAs, which maybe you should question some of the other planning they're doing. Again, there's reasons to use trust, but if someone is telling you to put an IRA in a trust, that cannot do it while you're alive, and so that should be a red flag, honestly, for the planning on that front. And then number 12, cannot change ownership during life. Again, similar to these other ones, is I can't have my spouse take over ownership, because often we'll get, "Oh, we jointly own this IRA." It's, no, you don't. It's your IRA. Your spouse might be the beneficiary of it, but you can't transfer ownership while you're alive during that. So again, less options to do how to handle the account because it's within the IRA. So I'll turn it back to Hans here for 13.
Okay. They cannot be jointly owned even in community property states. There's people that come into us that think that they jointly own their IRA with their spouse. Now, their spouse may be the beneficiary in the IRA that's going to become the owner when the principal passes away, when the owner passes away, cannot be jointly owned, even in community property states. So, and we've had other shows on community property laws, but they're superseded. An IRA during lifetime is only in one person's name. And then at death, it changes to the beneficiary's name, or the multiple beneficiaries. It gets split up. Number 14, the equity inside of an IRA cannot be tapped. We have lots of people come to us and they try to do that, and that's the first stop sign. When you own other assets, you can borrow against them. You can make withdrawals. You can put them up as collateral. That cannot be done with an IRA. So I want to put it to Tom to finish the list.
Yeah. Number 15, beneficiaries may qualify for special tax breaks often missed. And so this gets into the complexity of the rules around IRA beneficiaries. There's a subset of beneficiaries that qualify for special rules, and we see this all the time where people miss it. They assume they fall under the normal rules that most people do, but they actually qualify for one of these exceptions, which makes it more favorable, but they miss it, right? Because the rules are very complicated. So you need to understand how all of this works to understand how best to handle it when you're inheriting IRA. Number 16, no principal and income concept. This speaks to some of the ones we've talked about here. Like, there is no basis, there is no initial investment in it. It doesn't really track it there. Really, it's the balance, right? In the IRA, all of it is treated the same way. Every dollar coming out is taxable, taxable income. One of the benefits potentially of that is it allows you to, rebalance the accounts. It allows you to diversify without having to worry about tax complications, right? So in a taxable investment account, if you sell an investment, you have to pay capital gains. If you sell an investment inside an IRA, there is no tax impact, right? You can sell and buy things in an IRA all you want, and it's not taxed till you pull it out. So that's just different than other types of money. And then number 17 requires IRA estate plan. And so we talk about this a lot in our videos, is IRAs, as they pass to the next generation, were never intended to be a good estate planning tool. It's never a great way to transfer wealth to the next generation. With the Secure Act that was passed, that made it even less favorable. And so ultimately, you need to have a plan around how that's handled. And if you're relying on that as the main money that's going to go to your kids, we probably need to have a conversation, because that's not the most efficient way to do it. So again, across all the board, and again, we could do a show on each one of these if we really wanted to. And so we gave you a little taste on how it's different. But again, back to the why of the show, IRAs are fundamentally different than the rest of your money. And if you don't have a plan around how to handle specifically the IRAs, you need to call us and we can help develop that plan out for you.
Yeah, this last one, number 17, we talked about estate planning. And when you name a beneficiary, on an IRA, you've created an estate plan, because when you die, the beneficiary is going to receive this money. Now, I can take that to how much tax are they going to have to pay? There's several things you can do to prepare for this. I mean, you can convert it to a Roth, and so they're still going to have to distribute it, but they're not going to have to pay any tax. You can pull out little bits over several years and buy life insurance out of the little bits you're pulling out, and then your beneficiaries are going to get the money tax free. So you can create an estate plan just by putting a beneficiary down, but we can go way beyond that if that's what your goal is. But some people don't really care about the estate plan. Well, then there's ways we can deal with that. Okay. This whole show has been about taxes underlying, because it's just what makes IRAs different is that money has not been taxed, and it's going to get taxed. And there's a strategy to do this efficiently, to do that, to lower the tax over your lifetime, leaving you more money to spend out of that. The show has been about income, because that's what most people do with at least part of their IRA. Some of them do it with all of it, is they create a lifetime income to live off of in addition to their Social Security. Obviously, we're talking the whole show about IRA 401k. We haven't talked about long-term care today. We haven't talked about Medicare, and we really haven't talked about Social Security. So these check boxes are all in light of comprehensive financial planning. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.